Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Dollar General stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Dollar General is the largest discount retailer in the US in terms of total stores with 17,266. It sells national brands from leading manufacturers, as well as its own private brand selections with prices at substantial discounts. Most of the big retail chains put stores in areas where there are lots of people and the average income is high. This company does the opposite. It targets areas with few people and the average income is low, since no one else is marketing to those individuals. 75% of its stores are located in towns with less than 20,000 people. This strategy has worked well since it has grown its store count and same-store sales pretty much every year for the last 25 years. The company was founded in 1939 as JL Turner Son Wholesale. So in the beginning, the company acted as a wholesaler and sold products to different retail stores, but then they changed their business model, and in 1955, it opened its first Dollar General store. This was the first dollar store ever opened in the US, and right off the bat, it was a huge success. In 1968, it changed its corporate name from JL Turner Son Wholesale to Dollar General Corporation. Through the 1960s and 70s, it grew a lot, mainly through acquisitions. But the issue was, it was getting too costly to acquire all of these other companies. So in the 80s, it focused on organic growth by opening more Dollar General stores. This strategy worked the best since it is the most profitable dollar store with the most locations. The reason they're so profitable is because they're the only store in these particular neighborhoods. Walmart, for example, will not go into these small, low-income towns. They're in big cities, so people have to travel to Walmart. But there's easy access to Dollar General in all the really low-income neighborhoods. The company is headquartered in Goodlettsville, Tennessee, and was founded in 1939. It trades on the New York Stock Exchange, Mexican Bolsa, Deutsche Börse, Vienna, EuroTLX, Sao Paulo, Lima, and London Stock Exchange. Let's get started with the model. This is a large cap company, 51 billion market cap. They're trading at $2.20 a share, and they have 233 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they have lots of free cash flow every year. In 2021, they had nearly $3 billion of free cash flow. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that was under $2 billion in 2019 and 20, over $2.5 billion in 2021 and the trailing 12 months. Revenue is the sales for the company, and anytime there's a recession or a difficult economy like COVID, this company does even better. They had their highest sales in 2021 at $34 billion. This is the company's income statement. The top line is the revenue, the sales. Here's a breakdown of their 2019, 2020, and 2021 revenue. It's broken down by consumables, seasonal, home products, and apparel. Examples of consumables are toilet paper, paper towels, food, drinks, also shampoo, pet supplies, tobacco. Every year their revenue goes up in each division. Their second largest is seasonal. That includes items for holidays, toys, batteries, hardware, electronics. Home products is their third largest. That includes things like cookware, light bulbs, and candles. And their smallest division is apparel. These are clothes for adults and children. Also included are socks, diapers, and shoes. Below revenue is the cost of revenue. These are the expenses directly related to generating the revenue. Their big cost of revenue is cost of labor and cost of inventory. Revenue minus cost of revenue gives you your gross profit, and that grew from $7.8 billion to $10.8 billion. Below that is their operating expenses, and below that is their operating income, which is up from $2.1 billion to $3.4 billion. It's down a little from 2021. They do have a good amount of debt on their balance sheet, but regardless of how much debt a company has, whether it's $1 million, $1 billion, $100 billion, just make sure they can cover the interest on their debt. $1 million is too much debt if they can't cover the interest payments. $100 billion of debt may be appropriate if they can easily cover their interest payments. And as you can see, they have $3.4 billion of operating income and only $160 million of interest on their debt, so they can easily cover the interest payments. Even though their capital structure is 2/3 debt, the amount of debt is appropriate based on how profitable the company is. And the bottom line of the income statement is their net income, which has gone up from $1.6 billion to $2.5 billion. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. So they generate a good amount of cash flow each year. 2021 was their best year, close to $4 billion. And the way you calculate operating cash flow, you start with net income, then you add or subtract the non-cash items on the income statement. Depreciation is their main non-cash item since they own so much real estate. You also have to adjust for changes in working capital. They added a lot of accounts payable in 2021. That increased their cash flow $745 million. When they actually pay for the accounts payable, then at that time their cash flow would decrease. So the reason they had so much operating cash flow in 2021 was because their net income was a lot higher and also this large accounts payable. Also, it looks like they added almost $400 million of accrued expenses and other liabilities. These are more timing items. The fact that their net income was much higher than prior years, that's a great sign. And then you have capital expenditures, which are investments in property, plant, and equipment. They have to spend a lot on CapEx because they're always opening up stores. These are the things that go into capital expenditures: land improvements, buildings, leasehold improvements, furniture, fixtures, etc. And as of 2021, the cost basis for these items was $7.3 billion, but they depreciated $3.4 billion, which means the value on the balance sheet is $3.9 billion. If you look on the balance sheet on net property and equipment, they report $3.9 billion. So if you're ever curious what's behind these numbers, they usually tell you in the 10K. They sometimes buy the actual land and then build the structure of the store, the building. So they spent $1.3 billion in building the actual structure, and they depreciate that over 39 to 40 years. Eventually, the value of these buildings will be zero, but they're always adding new buildings, so they're always going to have something in this column on the balance sheet. But land does not get depreciated. It has an indefinite life. So the value of this land may be a lot higher than they report because they can't increase the value of the land. They could decrease it by passing through an impairment, but they cannot increase it. So if you know they bought a lot of land in a place 40 or 50 years ago that was not popular, but it is now, then maybe their balance sheet is underreporting their land, and that could be a good investment opportunity. Operating cash flow minus CapEx gives you your free cash flow, and they use their free cash flow to pay you a dividend and to buy back stock. Those are the two main ways to reward investors. So they bought back $1 billion in 2019, $1.2 billion in 2020, $2.5 billion in 2021, and $3.5 billion in the trailing 12 months. They did add about $1 billion of debt in 2021. But like I said earlier, I wouldn't worry about debt because they can easily afford the interest on the debt. They raised $3.5 billion from selling their business, and they profited $2.4 billion from running their business. Retained earnings is a sum of all your prior net incomes. And when some companies buy back stock, they list it as treasury stock on the equity section of the balance sheet. They don't do that. They just reduce retained earnings. So it is hard to tell how much stock they bought back. So their retained earnings should be a lot higher if they didn't buy back any stock. Some companies have negative retained earnings because they bought back so much stock, like Boeing, for example. Let's look at the capital structure. They have $6.1 billion of equity, $13.9 billion of debt. They're 31% equity, 69% debt. And their weighted average cost of capital is 7.2%, and that's the middle whack on Finbox. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $54 billion. We discounted those numbers back to today using the weighted average cost of capital. And we get a value of the company of $48 billion. We divide that by 233 million shares. And we get a calculated stock price of 208. They're trading at 220, so they're trading at a 6% premium to sell according to the model. The average analyst projects their revenue to grow 6.6%. The way I calculated their future revenue, I just grew it 6.6% a year. To calculate their future free cash flows, I need to see what percent of their revenue they convert to free cash flow. So I summed up these 4 free cash flow numbers divided by these 4 revenue numbers, and that comes out to 6%. So I multiplied their future revenue estimates by 6%. That's how I got their future free cash flows. And my valuation is really close to where they're trading at. Simply Wall Street values the company at $248, so they're saying it's 11% undervalued. 8 analysts priced this stock and the average price target was $252. 23 analysts priced this stock, the average price target was $247, the high was $272, the low was $187. 27 analysts rated the stock, 15 a buy, 7 outperform, 3 a hold, and 2 an underperform. Nobody rated them a sell. This is where the stock has been trading the past 52 weeks, so it looks like it's pretty much trading where it was 52 weeks ago. But it's kind of all over the place. It went down, then it went up, now it's coming back down. Since 2010, this stock has performed a lot better than the S&P 500. If you invested in this company, you would have doubled the S&P's performance. They're up 941%, the S&P 429%. They pay a quarterly dividend and they seem to raise it every year. It was 25 cents, now it's up to 42 cents. The dividend yield is only 0.79%, 79 basis points. To calculate the dividend yield, you could just multiply the last dividend by 4, take that number, and divide by the stock price. They pay out 15% of their net income and 34% of their free cash flow. So they can easily afford this dividend payment. I think they like to save a lot of cash to buy back stock. They do pay a smaller dividend than their industry. Their industry pays a 1.3% dividend. They have a beta of 0.51, so the stock moves half the market. It's not too volatile. It did seem like the stock was pretty volatile, but you have to remember beta is based off a regression analysis. So you have to look at the price movement between the S&P 500 and this stock. If you did that, you would notice it's not too volatile. And the stock is only up 4% in the past 52 weeks, while the S&P is up 34%. The 52-week low was 173, the high was 239. And the stock is trading above its 50-day and 200-day moving average. Over 1 million shares are traded on average each day for this stock. Of the 233 million shares outstanding, 231 million are on float. They have a really high institutional ownership. 94% of the stock is held by institutions, and under 2% of the shares are shorted. This is the company's short percentage since 2011. It looks like it peaked around 2017, 2018, pretty close to 8%. But the short percentage is getting pretty low, under 2%. Their employee count seems to go up steadily each year. They're up to 158,000 employees. If you put $10,000 into this company 10 years ago, you'd have $59,000 today. That's a 20% annual return. That makes sense because earlier we saw this double the S&P 500's performance, and the S&P generally goes up about 10% a year. The only insider trading the past several months was just by one individual. It was a sell order for 9,600 shares. The biggest shareholder is Capital Research at 8.5%, then Vanguard, BlackRock, T. Rowe Price, and State Street. Let's look at their financial ratios. They have a really good PE of 20. When a company is not growing too much, a 20 PE isn't so great. But the fact that they're growing so much each year, a 20 PE is really impressive. That's better than a market median and market average. That means investors are paying $20 for $1 of earnings. They also have a really good price to sales of 1.5. Their price to book is a little high at 8.4. They do have a good amount of intangible assets on their balance sheet. So they only have $599 million of tangible equity. The rest is intangible. They have a good return on invested capital of 13%. I like to see at least above 10%. They can easily cover their interest payments 21 times. They have a really high ROE of 41%. You can inflate your ROE by taking on a lot of debt. And they have a good current ratio of 1.1, but a really low quick ratio because they have so much inventory on their balance sheet. At any given time, they're going to have a lot of inventory, but that inventory is turned over pretty quickly. If a company is sitting on a lot of older inventory, that's a big problem. They can move inventory really quickly, plus they have a ton of stores. If there were certain items that they couldn't sell, they would just mark them down until they sold them. So they do seem to be well capitalized. They had $1.1 billion of free cash flow in the trailing 12 months, $500 million in working capital, and they spend about $400 million in dividend payments. So they have about $1.3 billion of funding. The best way to look at ratios to compare them to companies in the same industry, I've done videos of 7 companies in the same industry as DG, and if DG has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So they're better than average in PE, a little worse in price to sales, a bit worse in price to book. They have a good current ratio, but I bet all these companies would have a really low quick ratio because they all sit on a lot of inventory at any given time. They have a really high ROE. They're the most profitable company in this industry. So by focusing on their niche, the lower income communities, they manage to be the most profitable company. That's pretty impressive. Their debt is a little higher than average, and they are the 3rd biggest company on this list. But Walmart and Costco are such huge companies, the average market cap is over 100 billion. Their dividend is lower than most companies in this industry, but if you add the share buybacks, I bet you they give back more to their investors than most companies in this industry. So to summarize, I have them trading at a 6% premium, but this company seems like a really good long-term play. They've been consistently growing their store count and revenue for 25 years now, and their margins are higher than pretty much every other company in this industry. So they really figured out the right formula for success. I ranked their free cash flow 7 out of 10, their revenue 8 out of 10, and their ratios 8 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.